We are here to help you today in making some of those decisions that you will take together. Our team will be available with you all the way through this from this weekend till 31st of March, where if you need any allocations, any documentation, or any assistance in making the right decision way forward, we are there for you. Today on this call, we will be joined by our CIO Shankar and Naren, who will help us with the way forward, and our head of products, Mr. Chintan Haria, who will help us with the Q&A. I will request you all to please type all the questions that you all will have, all the queries in the checkbox below. Chintan and I will help try and answer those questions for you. Naren, over to you. Thank you.
Welcome to all of you. What happened on yesterday was not predicted by any of us, and it was something which came out of the blue. It's part of the government's thought process of reducing exemptions and removing whatever are deemed to be exemptions. They have a view that in all the ways in which you invest in fixed income, you have to pay tax. And that is something that they have decided. And if you know, over the last few years, they have actually gone and done it on insurance industry. The banks never had the benefit. And they decided that it was there was a loophole in the MLD industry, and they clearly saw that the mutual fund industry had the last benefit of indexation and long-term capital gains and that kind of an indexation on debt investment. So the government, in its wisdom and in their thought process, have done it because they want a level playing field between banks, mutual fund, insurance, direct investment in debt, everything, and that is why they have done it. Is that step that the mutual fund industry will want? The answer is no. But is that a step that the government needs? The answer is yes, because finally, at the end of the day, the government needs revenue. And this is one of the best ways in which they can get revenue. We don't think this will be withdrawn. And we think this will continue in the current shape, because if you look at what they have done in insurance, what they have done in MLD, this is part of a big game plan that they have. The only areas that we think that can be done right now, they have said domestic equity securities. We are thinking that they should make it domestic equity ETFs and domestic equity mutual funds, and that is something we'll work on over a period of time, because I think their intention is that anyone investing in 100% debt should be asked to pay tax, and that is there. And anything that is invested in more than 35% equity is something which they are fine with, and that is how they see it, and that is how I think the whole thing will move. What does it mean for you? So whether it is in insurance, whether it is in mutual fund, they have clearly decided that they will not do anything retrospective. So one of the most important things which people have to understand is that your existing investment is completely protected from the rule which applies from 1/4/2023, and even investment that you make the entire next week is protected from the investment from the rule which stands from 1/4/2023. This is very, very, very important for all of you to note, and this is something that you have to consider. This is not true of just mutual fund industry. This is true of even the insurance industry. And this is a process that they have always followed in the recent past as part of their framework, that they will do nothing retrospective. So you have to remember that if you make an investment next week, they will not do anything retrospective. And that is an opportunity from your point of view to invest for the long term with indexation in a fantastic industry called the debt mutual fund industry. And that is an opportunity that exists for you in the next 1 week, which you can make use of, and which you should make use of. And what are the kind of, given the riskometers, what are the kind of products that we like in that area? Clearly, we like a product like All Seasons Bond Fund. Because see, when you want to buy shut it, forget it kind of frameworks over the next 10 years, 20 years, 30 years, 40 years, what should you do? You should invest in a product which has maximum flexibility, because that is the kind of product which you will have a situation where if something were to change, you are in a very, very smooth situation from an investor point of view. So that is why, if you ask me, given that you want to invest next week for buy it, shut it, forget it kind of model, I would say that it is the kind of product that makes sense. Because think about it, if you wanted to invest in a product in the equity side, you would think of flexi cap because it can do anything. If you wanted to invest in hybrid, you would think of either balanced advantage. If you wanted to invest in multiple things, you would invest in multi-asset. So I would say that All Seasons Bond Fund within the debt category kind of meets that requirement on the situation at this point of time, because it can do anything. Suppose the environment 4 years from now were to change, and at that point of time you want to be at zero duration, the fund manager has the potential to be at zero duration, very low duration at that point of time. Suppose the situation 4 years from now seems to suggest that you want to be at very, very long duration, the All Seasons Bond Fund kind of product actually makes sense for you to invest, be in very long duration. So I would say that the best buy it, shut it, forget it kind of product. I don't know the riskometer, but I'm saying that that is the kind of product that one would want to invest in. Because given the way taxation is, you would want to invest today and sit into that product from a investor point of view. On in the long term, you would like to invest in it in that situation. The other two products which clearly we like for the long term for investment in the next 1 week, one is asset allocator fund of fund and passive multi-asset fund of fund. Both these products, if we tell you next week to invest, it is with a view that nothing changes. But it is possible in the next 1 year or so, the tax law changes, and any equity fund is treated as equal to equity securities, and equity ETF is treated as equity securities. In that case, these products come back to life from a taxation point of view. Otherwise, both asset allocator fund of fund and a passive multi-asset fund of fund are both interesting from that point of view. So ultra short kind of product is also something which in the very long run may not be a bad idea, because you're not taking duration, although logically over a 10-year period or a 15-year period, All Seasons Bond Fund kind of product would always meet a better expectation than anything else. Should you make use of the next 1 week? Luckily, what has happened is this situation of at this point of time, debt is an interesting asset class at this point of time. And it is not that interest rates are low like 2021 or 22. At this point of time, we have seen multiple rate hikes, and the global environment is also much higher today at this point of time. And we have a situation, it is not that we are investing at a period of time where interest rates are too low anywhere in the world. Interest rates have gone up substantially everywhere in this world. So from a long-term investor point of view, debt represents a very interesting asset class. So if you get over-invested in debt due to whatever we are trying to tell you today, it may not be a bad idea. And if you look at all our public utterances which have happened independent of taxation, you can go and look at what we said in our January outlook piece. You can look at what we said in our Diwali piece. You can look at all our public utterances over the last 6 months. We have been actually recommending debt. So by being over invested in debt at this point of time, through categories like all seasons bond fund or ultra short may not be a bad idea. Of course, there is a riskometer involved in all these products, and we will display it in our disclaimer at the end of this call at this point of time. So would we worry about being over invested in debt? Answer is no. Did we talk about being over invested or recommending debt? The answer is yes, independent of the taxation view. And so it is not a view which has come up in the last 2 days arising out of taxation. You can go and look at all our public calls. You can look at all the statements that you have made. You can look at our annual outlook also. So actually, there is a mirroring of our annual outlook and the taxation. Due to taxation, your interest in investing in the next 1 week, both of them happened together, luckily. It is not that you're making an investment against our outlook call at this point of time. As you know, for the year, the call was safe. It was SIP, STP, asset allocation, fixed income, and equity savings, equity arbitrage. So it is fully in line with our market view. So you're doing something in line with our market view. You're doing something at a time when we think the market view suggests an investment. And we believe when we look at our entire investors portfolio, people are not over invested in debt through the mutual fund route. So it is completely aligned, if you ask me. So the opportunity is mega. Only thing, the opportunity is actually now for 4 days. And I believe that the opportunity is for those 4 working days, Monday, Tuesday, I think Wednesday and Friday. And you have to make use of those 4 days. Does the government realize that there will be front ending? The answer is yes. There has been a front ending happening even on the insurance side over this period. And they recognize that there is a savings that will happen prospectively where no one will be able to do anything. This is only for accumulated savings that people will be able to do something. So they also recognize that. And I think the government is extremely smart in ensuring that all future savings get taxed. And I think we have to owe it to this government for actually plugging every loophole which exists in the taxation of fixed income at this point of time in a brilliant way over a period of time. So that's how I see it. So is there anything that we need to worry about investment over the next 1 week in debt? The answer is no. Is there anything to worry about investing in asset allocator, fund of fund, or passive strategy, fund of fund at this point of time? The answer is no. There are 2 other products also where I believe that if you want to take an exposure and you're sitting at 0, you should consider is gold and silver. Because after 1st April 2023, these products are also treated as, if you ask me, global, they are treated as debt schemes. So if you want to take a category, a situation as far as gold and silver is concerned, again, I would say if you want to take an allocation, this is possibly the best time for you to consider that gold and silver call also at this point of time, because after 1st April, the same situation were to arise in gold and silver. There is the other areas are interesting where again you should consider immediately is a product like Global Advantage at this point of time and Strategic Metal at this point of time. Both these products also at this point of time are to be considered because again after 1st April they are treated as debt schemes. So I would say both Global Advantage and Strategic Metal are also products that have to be considered at this point of time. So I believe that you have a wide set of products to be considered before 31st March. And I believe that there is no choice for you but to consider all of them bunched up. And each of these products are interesting because you look at strategic metal, oil has crashed. So gold has done well. So the gold part of it is not the good part of it. It is the oil part of it, which is very good in strategic metal, which is something to consider at this point of time. If you look at Global Advantage, most of the global markets have done very badly compared to India in the last 3 years. So it is something tactically to consider. Anyway, after 1st April, it's a big problem to invest. So I'm saying you're front-ending an investment at a tactical good time. So luckily for you, maybe gold and silver is the only area where there is a problem from a tactical point of view. I'm not clear tactically whether I would want to invest in gold and silver. So there I'm not clear tactically. I would not recommend it. To be honest with you, I'll not recommend it. So it will be your call to invest in gold and silver, not my call. So whereas in all the other things, whether it is passive multi-asset, whether it is asset allocator fund, whether it is global advantage, whether it is, if you ask me, strategic metal, I'm not mentioning US blue chip because I'm not clear on US at this point of time. And I would say clearly asset, all seasons bond fund, ultra short, all these kind of things looks from our point of view, both tactically from an investment point of view, and the other reason it looks very interesting at this point of time. So that is as far as the period till 31st March is concerned. Now, people, and I am also guilty, it looks like, we are saying that after 1st April, what happens? See, there, it's a question of a mental makeup. See, we are used to thinking in our portfolio of equity and debt separately and wanting to invest in debt separately, equity separately. The day you decide you're willing to combine both and invest in products, no, then things are fine. Are you capable of doing that? Are you not capable of doing that? That's a question I have to ask you. See, as a human being, as an investor, I'm capable of doing that. So what happens is, if you look at all that we have advertised in this current year, maximum product that we have advertised is this multi-asset fund, for example. Why did we market multi-asset fund maximum? Because in one product, you get everything. You get equity, you get debt, you get gold, you get REIT, you get InvIT. So what people don't realize on that Thursday evening, that income tax bill, there was one positive in all the negatives. In that positive, there was REIT, and InvIT, there was a positive. So if you look at it, we had holdings in all our REIT and InvIT, and therefore we benefited out of that REIT and InvIT. So in multi-asset, there are a lot of things, but along with that, it has gold, REIT and InvIT. So it benefited out of all the REIT and InvIT holdings. So if you ask me, are you comfortable with the idea of having one fund which has everything or not? That's a question that you will have to ask. If you want to have only through debt, then the taxation is much higher. But what I would encourage all of you to do is, can you buy a masala like multi-asset? Then things are fine. But that is the challenge that you will have to get into. That involves some amount of thinking on your part, and that will involve a lot of planning on your part. You will need to think about it. You are used to managing equity and debt separately. Actually, as a framework in our company, we don't believe in that. As you know, we actually popularize products like balanced advantage fund, equity savings fund, multi-asset fund, equity and debt fund. Okay, all these kind of products, we popularized primarily because of the fact that we are believers in mixed asset classes. And as long as you are a believer in mixed asset classes, actually the time even after 1st April won't be that bad. But I'm still saying you front end all what you want to front end, and then think later on multi basis. Think on a mixed basis. If you think on a mixed basis, things are fine. And on a mixed basis, as you know, no, we have been always recommending everything to you on a continuing basis. We've been recommending all these things like multi-asset, equity savings, balanced advantage, equity and debt, all these kind of products to you. So I think those are fine actually. Then it becomes fine. Would you be okay with that? That's a question I don't have an answer to, but that is where the challenge is. And that is what we'll have to go. So I'm not involved in the AIF business. I'm not involved in those PMS, AIF kind of businesses. But those businesses today, which as a company we run, have a level playing field today after the amendment. So they used to always cry in our company. I'm not involved in them. So they're all actually very, very happy. So while I am not involved in them, you can ask, all those products become more relevant also. And maybe my colleagues can talk about it because I'm not directly involved in them. So I cannot talk about them, but they can talk about it. But all of them, many of those products become relevant. I'm a great believer in the mutual fund industry, so I cannot talk about it. But all those products are also becoming relevant. In my company, all those people were the only people who were happy on Friday. All of us were very sad, but they were happy. As a country, I was okay because I think we need more taxation. The more taxation we get, the government will be able to do more things. So that's how I see it. And as long as we don't have retrospective taxation and all the investors who manage to invest large sums of money with us in the next 4 days and stay invested with us in products like asset allocator fund, thematic advantage fund, passive strategy, multi-asset fund, all our debt schemes for years to come. See, there's one more very important thing you have to remember. See, this whole concept of indexation means that the longer you stay, the benefit you have. And in my opinion, one of the biggest things that ICICI has is it's an institution which was started in 1955. And it's an institution which has already been in existence for the last 65, 67 years. And it has seen a lot of cycles. So if you want to enjoy the benefit of indexation over the next 10 years, 20 years, 30 years, you should stay with an institution with a sponsor which has already existed for the last 67 years. And so that benefit of indexation you will get on all your existing investments as you stay longer and longer and longer with us. And therefore, you should stay with such an institution. As an ICICI mutual fund also has just about completed 25 years. And, over the years, we have become larger and larger and larger. And we have created processes which allow us to manage larger and larger sums of money. That's why, as you know, whether it is balanced advantage fund or whether it is blue chip or whether it is value discovery or the largest liquid fund or one of the largest liquid funds or one of the largest credit risk funds. So I believe, when you have to look at indexation and you have to invest based on indexation for the next 10 years, 20 years, 30 years, ICICI mutual fund is a good place to invest for the next 4 days. For the indexation benefit you will get over the next 10 years, 20 years, 30 years. We have actually managed money in the long run in a very nice way. Not that past is equal to future. That's what SEBI always says. And I have to also repeat it, that past never is equal to future. But the goal of our company is always to manage the money that has been given to us well. Because look at it, we have 5 lakh crores of stock. And what we get incrementally is very small compared to the stock. So if we don't manage stock well, we'll get into deep trouble. And that is why for us, stock is much, much more important than flow. And that's how we see it. So I think putting money for the next 4 days for the very long term, staying with the money that you have invested with us in debt and products like asset allocator fund or thematic advantage fund for the long term is also very important. By and large, it looks like the way the taxation structure is, you have to stay with us forever till you don't need the money, till you need the money. And I would say that that's how I look at it. So broadly, this is what I wanted to convey. I've taken a little bit more time than I had planned because this is a very important call. This is not like one of those market calls. What decision you take in the next 4 days is very important. There is no case to redeem money from debt funds. There is a case to invest very large sum of money in debt funds. There is a very large case to invest in products like strategic metal and global advantage for the long term. There is a large case to invest in products like asset allocator fund for the long term. So I would say these are all opportunities which exist for you. And we will try our best to manage all the money you give us for the buy it, shut it, forget it kind of models as well as we can. Not that we won't make mistakes, but that will be our endeavor. This is broadly everything that we wanted to convey. Anything Abhijit, Hamavan, Komal, I missed out in my conversation, you can ask me, because then after that, I think Chintan and Hamavan will take care of the questions. So I would just want Abhijit, Hamavan, then Komal to say anything that I missed out.
No, I think Naren, you covered everything that we wanted to cover. There's a lot of questions. I think we have about 35, 40 questions right now coming in the chat line. And two things, we will definitely share the recording of this video. At the same time,
So just don't worry about the mutual fund industry. Your long-term money that you have in debt is very safe, and you can relax, in my opinion. The steps taken by the government of India are actually very good steps. So unfortunately, you have to remember some steps which are good for the government, for the country, are bad for us. And this is one such step. So my wife was asking me yesterday, is it a bad step? I said, it's a bad step for ICICI mutual fund, but I can't complain about the step from the point of view of the country. It's one such step because, finally, where we have to have a situation where everybody who is investing in fixed income is charged. So of course, as an AMC, I believe very strongly that, we can manage the money that you give us in the next 4 days in a beautiful way, as well as we can. And of course, we'll make mistakes, but rest assured, we'll try our best. That's all I wanted to say. Thank you.
Thanks a lot, Naren, for the confidence.
Thank
and we will keep on engaging with clients. Hamao and Chintan, you can go to the next section. Thank you, Naren.
Thank you. So now we'll try and answer the questions with our head of products, Mr. Chintan Arya. Chintan, the first question is, will debt funds value go down after April 1st since people may not go for debt funds?
Yeah, thanks, Aman, and thanks, Naren, for the insights. There is one question which says, if you can explain in Hindi also. So maybe I'll take 2 minutes of your time after this question on explaining whatever has happened and changed in Hindi in just a very quick one. But from a investor standpoint, the natural investor psychology will be that they will stay invested with what they have for the longer term to get benefit of the indexation. So if you finished 1 year, 2 years, 1.5 years, 2 years, you will continue and want to be in products which continue giving you that compounding benefit and indexation benefit. So we don't see outflows from mutual funds based on this announcement. In fact, what we are saying and what Naren has mentioned, use the next 4-5 days up to 31st of March to invest as much of your money that you can in the products which Naren mentioned. There were many products, and I'll repeat them as and when the questions come, so that you get the benefit of indexation in your non-equity investments, and that stays with you for the longer run. So what we feel is that more money will come into the mutual funds in the next 5-6 days. And as Naren mentioned, even after 1st of April, now that there is a level playing field, it's not like mutual funds become less attractive compared to something else. They were more attractive compared to other investments earlier, but now it is a level playing field. And so we do believe that the inflows will continue. The pace of inflows will be determined by the savings that are there in the country. And we do believe that the growth will continue to happen in debt mutual funds. Thank you.
So thanks, Chintan. The next question is, how are SIPs in ICICI NASDAQ 100 ETF going to be treated? Is it that the SIP post 1st April will be taxed at slab?
Yes. So as things stand right now, there is no carve out for international funds, for gold, for silver, or any of the funds which do not have minimum 35% in equity. So to explain the law as it stands today, only those funds which have gross exposure of more than 35%, 35 or more than 35% in domestic Indian companies, that is domestic equities, will get the benefit of equity taxation. Rest everything loses their indexation benefit. And to that extent, international funds, gold, silver, or any of the funds which have underlying as fund of funds or ETF, as of now, will lose their indexation benefit if you invest after 1st of April 2023. As things stand right now, your current investments will continue to get indexation benefits and whatever you invest up to 31st of March. But after that, if you invest even your SIPs, which come after 1st of April 2023 in any of these categories, which do not get the benefit of indexation, you will lose the benefit of indexation in those categories. Thank you.
So we have a question from a client who is a large investor in international funds and in our PMAF, passive multi-asset fund. He has a question, can this strategy be reconceptualized to ensure equity taxation?
Sure, thank you. So just for the benefit of everyone who's listening, we have an ICICI Prudential multi-asset fund, which has been in existence for more than 20 years. That's basically an equity taxation product. About 1 year back or so, January 2022, I think, we brought out with the ICICI Prudential Passive Multi-Asset Fund of Fund. And the question is on the ICICI Prudential Passive Multi-Asset Fund of Fund, which is different from the ICICI Prudential Multi-Asset Fund. So ICICI Prudential Passive Multi-Asset Fund of Fund essentially invests in the 4 categories that generally all of us invest only in passive funds. So equity, Indian debt, gold, and international funds. The question is, can we reposition this fund in a way that it will get the taxation benefit? Since this fund is investing only in underlying ETFs and index funds, based on the current notification that the investment has to be in domestic funds, we probably cannot change anything in the fund right now. We will see if we can maneuver it in a way that we can have domestic 35%, but that concept does not exist right now in India, wherein you have a fund of fund which can invest in a equity as well as in a fund. So let us go back to the drawing table, and if there is a possibility of that change with the regulations or the modified regulations at a future date, we'll definitely try and make that attempt. But as things stand right now, after 1st of April 2023, the fund of fund, that is the ICICI Prudential Passive Multi-Asset Fund of Fund, would lose its indexation benefit for investments after 1st of April 2023. Thank you.
Thanks. Does it make sense to shift from investments which are in target maturity funds to ideas which are our core recommendations, like the all seasons bond fund, short-term fund, or the credit risk fund, where they can hold it perennially?
Yes, so there is a case for the investor to think that if they don't need the money after 3 years, 4 years, typically if you invested in target maturity and you feel that that money would be utilized for some purpose, for some target, then you can continue to keep it there. Because if, for example, you finish 6 months, 1 year in the target maturity fund and shift right now, you will lose that benefit which you basically got till now. So there's a trade-off there. And if you continue for 2 years, 3 years, and then that money you can utilize, maybe for investing in a hybrid fund like the Balance Advantage Fund, or any other investment at that point of time which you may be requiring based on your goal, then you may continue with the target maturity. If you feel that there is money for next 8, 10, 15 years and you don't need it, then you may look at the shift, but think of the taxation impact that you will bear when you shift right now, and then take the informed call. Thank you.
So thanks. If the next question is more about asset allocation and debt allocation in that, if somebody has a very long horizon of 10 and 20 years and they would want to target that duration in fixed income, what kind of products would suit their horizon, and do hybrids have a role to play in that?
Yes, so typically if you have a horizon of 10 years, 20 years, you're talking of 2 to 3 economic cycles where the equity ups and downs happen, where the debt cycles also of interest rates go up and down. While in case of equity hybrid, we say that Balance Advantage Fund, ICICI Prudential Balance Advantage Fund is a good choice along with ICICI Prudential Multi-Asset Fund. The question here is, in debt, what would you choose? And the answer comes down to a product which can maneuver its credit quality, which can maneuver its duration based on the existing realities of the debt market. And to that, there is one answer which comes up front, which is the ICICI Prudential All Seasons Bond Fund. I think it's the first fund which Naren mentioned. So all of you are looking at really long-term investments where a product can be low on duration, around 2 years duration right now, and it can increase its duration when the view on the rate cycles turn, and it can reduce duration when when we expect interest rates to go up. So with this interplay between rates, duration, and credit, the ICICI Prudential All Seasons Bond Fund becomes a choice for those looking at debt investments for the really long run, and you don't need to worry about then coming out or in terms of the duration or credit. Thank you.
Thanks. So this is an interesting question. Since investors like to target a net return of around 7-8% on the fixed income side, to target that kind of a return, should we go down the credit quality and buy A-rated papers at 9 to 10% and then offset that tax to still make that 7%? Should that be a strategy, or do we believe that it should be spread out?
So if the investor, my analogy, because I've always think in forms of equity, but the analogy comes that many people, when small caps do well, suddenly feel that to increase yield, I should increase my small cap equity component. Similarly, here the question is that should I go down the credit curve, choose myself, and then increase the yield of my portfolio? if it was easy or if it is easy for an investor to do the due diligence, to have the right mix while taking risk into account, then you may go down the credit curve. But then as we've seen in the last 7-8 years, not just in India, outside as well, when you go down the credit curve, you have to be razor sharp in terms of your selection. You have to be razor sharp in terms of your allocation. And you can lose a lot more than you can gain by that edit 10, 15%, 20% in A or below, I mean, A or let's say high yield paper. So high yield, much like small caps, is a very professional input required from a selection perspective. So I would just say that in debt, of course, while you need returns, you need safety also. And to balance the two, you should stick to probably mutual funds which do that. And Naren mentioned about AIF. So the credit opportunities AIF also becomes an opportunity for those who are looking at that, because you have professional investors in investment help over there. So, I mean, our relationship managers can help you with that also, how you can manage risk and reward while you go down the credit curve. Thank you.
Do you recommend switching monies lying in liquid and ultra short-term funds to be used to take opportunity over here and move it to longer duration papers?
Yes, so clearly, whatever monies you have, not just in liquid or ultra short term, there may be some lying outside the ambit of mutual funds also. You may want to think, because now you have a limited window of opportunity in terms of the indexation benefit, do you bring all of it on the table, decide where you want to allocate it, and allocate it now? Later on, of course, you can decide if you want to reallocate it somewhere, but to gain the indexation benefit, not just the money which you have in ultra short term or liquid, but even outside of the mutual fund system, you may be having a lot of money which is probably lying in your banks, etc. You may think of allocating, depending on the choice of funds or mutual funds, where you feel it could be a all seasons bond fund, it could be a credit fund, it could be any of the funds of your choice, and you can allocate it so that your money does not lie idle. At the same time, the window of opportunity is short right now. You take the advantage of indexation, which is available up to 31st of March 2023 in the debt schemes. Thank you. And also Naren mentioned, and we've always been proponents of having a balanced allocation or having an asset allocation plan, which gives you an opportunity to go through the market ups and downs by having, right investments. So there we would say, while the core can be balance advantage fund, the international markets also people want to have allocations. The global advantage fund can help you in that fund of fund. If you look at gold and silver, depending on your allocations which you have existing, you can add there. And then the debt funds are of course there. So it's a mix along with the strategic metal and energy fund, which Naren mentioned. So depending on the choice where you feel that you are low on allocation right now, you may want to increase the allocation for the long run. Thank you.
So fixed income and conservative hybrids have always been a part of the retired individuals kitty or invest savings. So does equity savings fund also fall under this tax category one? And second, do you recommend all seasons bond fund for such people, for such investors?
Sure. So for conservative investors who want to invest in debt for the long run, getting the benefit of indexation, or even otherwise after 1st of April when the level playing field is there, all seasons bond fund is ICICI Prudential all seasons bond fund is a good choice to have, because it will take care, like I said, of the credit quality of the duration. Whichever paper is mispriced, the fund manager will take advantage of that, will try to probably bring it in the portfolio, and your compounding of your wealth will happen. On the equity savings question, the ICICI Prudential Equity Savings Fund or the equity savings category by itself, the gross exposure to equity in the equity savings category is generally 65% or above in the entire category. So you don't have to worry about any change in that category, because like I mentioned earlier, any scheme which has minimum 35% gross equity exposure to domestic Indian companies, you will not have any change in the taxation. So equity savings fund as a category continues to enjoy the taxation benefit of it being equity taxation. Thank you.
So the next question is about how we manage debt. What is that debt management process? How do we ensure that we don't have defaults, or we are avoiding situations which have happened in the past around 2020 April time, where there was a crisis?
So that's a process question. Before the process question, maybe I'll take 2 minutes of time to explain whatever the changes have happened in Hindi, so that those investors of ours who probably are more comfortable with Hindi get our view. बजट में जो प्रस्ताव लाया गया है पिछले कल जो प्रस्ताव पारित हुआ है उसमें जो चेंजेस हुए हैं 31 मार्च 2023 तक आप जो भी निवेश करते हो या आपने जो भी निवेश किया हुआ है, यानी कि आपके एग्जिस्टिंग इन्वेस्टमेंट्स और जो निवेश आप 31 मार्च 2023 तक करते हो, उनमें कोई भी टैक्सेशन चेंज नहीं है। आपको इंडेक्सेशन का बेनिफिट मिलते रहेगा डेट स्कीम्स में। 1 अप्रैल 2023 के बाद अगर आप निवेश करते हो कोई भी स्कीम में जिसमें 35% से कम भारतीय कंपनियां है, इक्विटी है, तो आपको वो इंडेक्सेशन बेनिफिट चला जाएगा। इस चेंज के वजह से अगर हम देखें तो म्यूचुअल फंड की जो डेट स्कीम्स है, इंटरनेशनल स्कीम्स है, गोल्ड सिल्वर, उसको इम्पैक्ट होता है और उनका जो टैक्सेशन है वो आपके मार्जिनल रेट पे आता है, जो भी आप निवेश 1 अप्रैल 2023 के बाद करते हो। 1 अप्रैल 2023 के बाद के चेंजेस है उसको समान टैक्सेशन मिल रहा है अभी आपके जो भी दूसरे डेट इन्वेस्टमेंट्स है जनरल आमतौर पर। आपको क्या करना चाहिए? निवेशकों को कोई घबराने की जरूरत नहीं है। आपके जो एग्जिस्टिंग निवेश है वो जैसे मैनेज हो रहे हैं वैसे ही मैनेज होंगे। हम ऐसा चाहते हैं कि आप आपके जितने भी निवेश के अपॉर्चुनिटीज और है, आपके पास जितना भी पैसा है जो लिक्विड पड़ा है, सिर्फ म्यूचुअल फंड्स में ही नहीं, म्यूचुअल फंड्स के बाहर भी अगर आपके पास कोई पैसा पड़ा है तो आप आपके एसेट एलोकेशन के हिसाब से इस जो विंडो है, ये जो 4-5 दिन का विंडो है, अपॉर्चुनिटी है, उसका फायदा उठाकर आप आपका जो पैसा आज निवेश करने के लिए आपके पास है वो आप निवेश कीजिए। हमारे जो रिलेशनशिप मैनेजर्स है वो आपके एसेट एलोकेशन के हिसाब से आपको हेल्प करेंगे। जो प्रोडक्ट्स हम आपको निवेश के लिए आपका ध्यान आकर्षित करना चाहेंगे, आईसीआईसीआई प्रूडेंशियल ऑल सीजन्स बॉन्ड फंड। अगर आपको डेट मार्केट्स में निवेश करना है लंबी अवधि के लिए, और डेट मार्केट्स में 2 चीजें इंपॉर्टेंट होती है, क्वालिटी ऑफ पेपर जिसे हम क्रेडिट कहते हैं, और दूसरा है जो ड्यूरेशन होता है, कितनी अवधि के लिए जो पेपर होता है। ये दोनों का फ्लेक्सिबिलिटी आईसीआईसीआई प्रूडेंशियल ऑल सीजन्स बॉन्ड फंड में है। तो अगर आपको पैसा लंबी अवधि के लिए निवेश करना है डेट में, तो आईसीआईसीआई प्रूडेंशियल ऑल सीजन्स बॉन्ड फंड में आप निवेश कर सकते हैं, और फंड मैनेजर अवधि और क्रेडिट दोनों का जो संतुलन है वो मार्केट के हिसाब से बनाए रखेंगे। संक्षिप्त में ये कहना चाहूंगा, अगर कोई और प्रश्न होगा तो जरूर हिंदी में उसका उत्तर देने की कोशिश करूंगा। अमन, ओवर टू यू फॉर द क्वेश्चन। थैंक यू।
Thank you. So, is it a good time to park lump sum money in global funds right now to take advantage of this time-bound limit?
Yeah, so I think the question prior to what I mentioned in Hindi was how do we manage money in a way that we probably are avoiding the situations where investors can investors' money can be invested in some of the pain areas. Number one, of course, that with an integrated investment team approach wherein the sourcing team is different, the risk team is different, and the investing team is different, we've been able to have a good mix of teams which have the necessary experience as well as have the ability to think forward in terms of macro, micro, what can impact the company because of the company fundamentals as well as the company's industry. And that has helped us avoid a lot of these issues which have cropped up. Like Naren mentioned, we try our best to avoid those issues, and still there may be some issues which may come up. Now, that's where the fund management skills and the fund management comes into picture, wherein you don't overexpose your portfolio to something which can be of a worry. So you diversify the portfolio. We not only diversify the portfolio, we've also, especially our credit schemes, tried to limit the concentration of investors. So both in terms of the investors with us, because when there is a redemption and if all investors start to go out, we should be able to manage that liquidity as well. So we think 360 degrees and try to provide a portfolio which is diversified, which has papers where the weightages are managed well and diversified, and also the investor diversification is there. I think that has helped us in good stead, and we hope we continue to do that. We already manage sizable money, and we've already built ourselves in terms of the structure to manage a lot more than we manage right now, because as you all know, India's savings are going to increase meaningfully. Currently, based on the 300 lakh crores of GDP, we have a savings rate of 15%, which is 45 lakh crores. that is an annual savings that happens, that 45 lakh crores. Some of it will come to the mutual fund. And as we grow to 500 lakh crores and the savings rate remains the same at 15%, we'll be saving annually 75 lakh crores. That's a lot of money. And we at ICICI Prudential Mutual Fund have already equipped ourselves to manage a lot more than we manage right now. And with your support, we hope to continue to grow. Thank you. Amy, the next question, please.
Are ETFs covered under this new tax regime? And it seems that there is a new category of funds where equity levels will be between 35 to 65%, which will continue to have LTCG at 20% with indexation benefit after 3 years. Any of our schemes which will get covered over here?
So based on the categories which are there right now, I think the categories are all pretty clear, right? The MIPs we can't go above 30, so that is a challenge in the MIP category. That also I think there's a cap from a regulatory standpoint. So if there is any opportunity or possibility of creating a product like that, we'll be happy. But let's see already existing equity savings fund, which has around 65% gross, and depending on which equity savings fund you choose, you get an exposure between 15 to 40% in equity. So there is already existing. We believe that if investors are happy to go the hybrid model, right, in terms of having equity and debt, then the ICICI Prudential Balance Advantage Fund is a suited model, because on the lower side, it goes to 30% equity. On the higher side, it goes to 80% equity. And as long as you know that you don't need the money for next 5 years, 7 years, 10 years, and you allow the compounding benefit of equity and debt to happen, it becomes a good choice. So while there may be a space between 35 to 65 with debt taxation, I think that space will probably be, and this is just a quick estimate, will not be as attractive as the space of the Balance Advantage Fund and the Asset Allocator Fund of Fund as it stands right now. Of course, Asset Allocator Fund of Fund, we do hope that at a later date, we are able to get the changes in the regulation so that that remains with the indexation, because it has underlying equity which will average more than 35%, or it could have equity which is more than 35%. But as of now, I don't think there is a need immediately for the 35 to 65, but we'll take that into consideration as a suggestion. I mean, the first part of the question was?
Are ETFs covered under the tax?
Yeah. So, ETFs are investing generally. Equity ETFs are generally investing in, and the law for ETFs is very simple. Anything which has minimum, you have to follow the index, and it will have equity of more than 95% as of now. So as of now, we don't have hybrid ETFs in India. But even if it is a hybrid ETF, as long as you have minimum 35% in domestic Indian companies. So all the equity ETFs which you will have as part of your investment, they have minimum 35% in domestic equity if it's an equity ETF. So you don't have to worry about your existing equity ETFs, as well as you don't have to worry about your equity ETFs that are there, which you will keep investing. So equity ETF is not covered in the changes. But yes, debt ETFs, because they are mutual fund schemes and they do not have underlying domestic Indian companies as equity, the debt ETFs do get impacted from the loss of indexation benefit. Thank you.
So this is a macro question. What is your view on the Fed's rate hike policy? Like, will they continue to hike rates going forward, or do we see an end to that?
Yes. So good question, and probably it is something which will take up about a minute and a half on the answer, maybe two. So we saw not just Fed, but European region, Japan, printing money at a rapid pace after March 20, the episode of COVID that we saw, to support the economies. That led, at the time when there were supply dynamic problems, that led to demand push, and the prices of aluminium, copper, zinc, everything went up meaningfully because there was this gush of liquidity. Post March 2022, this gush of liquidity is on the way down. The interest rates are on the way up, and we are already seeing that reflected in the prices of the commodities and ultimately lowering of inflation as we move forward. As we speak right now, 1-year returns of aluminium is minus 35%, copper is minus 15%, zinc is minus 25%, oil is minus 40%, natural gas is minus 60%. So these are some of the names which impact general economy, right? Crude oil being the largest, aluminum, copper, zinc. And along with that, the demand also slow down, which may eventually happen in US and Europe, would mean inflation would come down. So we may be at the end of the Fed rate hiking cycle. But then since the rate hikes have happened from virtually 0 to 0.25% to almost 5% right now, it may go up to 5.5%. This sharp increase obviously has its impact on the real economy and the banking system because the asset liability mismatch kind of hurts the banks. And to put it very simply in layman terms, the digestion of the high interest rates will lead to slowdown in housing, will lead to slowdown in consumption in US, which will bring down the trajectory of inflation. As far as India is concerned, we never had very low interest rates. We had interest rates which were always elevated as such or not very low. And so from an economic standpoint, we are in a very good shape relative to US and Europe. And we do believe next 10 years, we are going to continue to grow. So if you ask me, a large part of the allocation of your equity should be in India. And since Asia is very cheap, you can add Asia, but we are not believers that US is the right time still. Europe has its own challenges. Thank you.
Right. So there are a lot of questions on the multi-asset funds equity taxation. So I think our clients may be a little confused between the passive multi-assets taxation and the multi-assets taxation. Could you help them with that, please?
Yes. So I'll just clarify again. The ICICI Prudential Multi-Asset Fund, right? The ICICI Prudential Multi-Asset Fund, which basically invests in India equity, direct equity, which is essentially the stocks in India, anywhere at the gross level, 65 to 70% at the gross level, 10% to 15%, up to 20% can theoretically go, but commodities. Then it has some gold and other commodities and debt. So that's ICICI Prudential Multi-Asset Fund. It's a strong recommendation from our side on the pure equity side. You get the benefit of some debt and some commodities also as part of equity, and it is an equity taxation product. The other product, which is only investing in underlying index and ETFs, it is a fund of fund, and it is called ICICI Prudential Passive Multi-Asset Fund of Fund. It's completely different from the multi-asset fund. So the multi-asset fund, or the MAF as we call it, is an equity category, equity taxation, has more than 20 years of history. And ICICI Prudential Passive Multi-Asset Fund of Fund launched somewhere in January 2022 for the purpose of those investors who are looking to invest in index and ETF, but then you don't want to choose, pick, etc. We basically making it easy for you as a solution for your overall wealth management in financial products, including Indian equity, Indian debt. The ranges are there: 25 to 65 Indian equity, 25 to 65 Indian debt, 0 to 15 gold, and 10 to 30 international international funds. So this is a mixture. The passive multi-asset fund of fund is a mixture of these four categories, only investing in index and ETF. It was always a debt taxation product. You would get the indexation benefit if you invest up to 31st of March 2023 in passive multi-asset fund of fund, or PMAF as we call it in short. After 1st April, you lose that indexation. So please be distinct in terms of your understanding. While ICICI Prudential Passive Multi-Asset Fund of Fund is a allocation product across four categories, only in index and ETFs, and it will stand to lose its indexation benefit after 1st of April 2023. Existing investments and investments made in it till 31st of March, there is no change. Thank you.
Right. So our iProve multi-asset fund with its equity taxation continues to be an evergreen idea.
Absolutely.
Right. With so much money chasing debt papers in the next week, will yields come down significantly and then go back up in April, or will it, as a normal JFM phenomena, continue to keep tapering in the next quarter?
It is a possibility, but I don't. It is very difficult. I mean, if for example the yields do come down, then genuinely this call and in general the mutual fund industry has been successful in getting the right message across and getting the money inside. There may be an impact of a few basis points, but then if you compound it over 5 years, 10 years, 15 years, it will not have a meaningful difference in terms of the returns that the investor will make. The important is that even if the yields come down a little, the indexation benefit that you will get based on whatever you're investing up to 31st of March will be far superior in terms of your net return compared to the compression of the yields, which is logical. It should happen. I mean, it's logical to express some compression of yields because a lot of money should chase those assets which are there. But I don't think if we adjust for the indexation benefit that these 5 days will provide, anything that you invest after 31st of March will probably still be slightly inferior in terms of the overall return experience compared to what you get after the indexation benefit. Indexation benefit is a meaningful differentiator, right? Because today the cost inflation index may be 6, 5.5, 6. If it is as expected that the supply chain globally has broken, China costs which were coming down are going up, energy costs which are going down are going, which were going out are going up. If you have all these scenarios, the next 10 years, you may be a situation where inflation is sticky. And in that inflation, which is sticky or which is higher, if you have cost inflation index benefit, that probably comes to your benefit if you've invested in the next 5 days. So I won't worry about the yields coming down. I'll worry about ensuring that I don't have a single penny of my money lying idle without having been invested in the right mutual fund product. And that product choice is completely left to the investor. Thank you.
Moving on to the next question. Alternates, what is the role of alternates going forward? Do you see an uptick on the credit side over here?
So alternates per se, especially in the last 4-5 years, have become quite large because there was a space earlier in terms of credits. And when I'm saying alternates, I'm assuming that the question is on alternate debt, but I will answer alternate equity as well. But if you look at the alternate debt space, there was a time period where, of course, banks were doing their bit in terms of lending, and then mutual funds were large in terms of lending, be it loan against shares or the financing which was being done to the promoters at a higher yield. That after the events of 2017-18 and the changes in regulation in terms of how we can manage our products has meant that mutual funds have a certain restriction as to what they can do, what they can't. And that space is now being filled by the AIFs on the debt side or the alternates on the debt side. So be it loan against shares or be it mezzanine financing of promoters for the buyouts that they need to do, whichever space, probably you cannot get easy financing from the normal lending institutions like banks. You end up basically having that space created for alternates. And it is a growing space. Of course, in alternates, the minimum requirement threshold of investors is, I think, more, I mean, it's 1 crore right now, and it may increase if the regulations change. But for those who can take the risk, because anywhere where you are looking at a higher yield, and alternates typically target that, you will have slightly higher risk. But then that's where the fund management expertise comes in. And I do urge maybe Komal and Amawan to keep a call with Shekhar Daga, who heads our alternates piece on the debt side, for you to get the benefit of understanding in detail what that space is all about. And it is very relevant now that the taxation mechanism or the taxation range is the same. That may become a space which may be of interest to the investors, because there the yields are slightly higher. Earlier, the taxation difference meant that it was inferior post-tax, but now with the taxation becoming same, if the piece of alternate debt is managed well with the checks and balances in place, it may be a good fit for our investors who are listening on the call. And on the alternate equity space, of course, that is also a space which is growing. We are also growing in that space with in a meaningful manner. And we do believe that for those investors who like, certain level of, because mutual funds generally will be great for all the products that you have. But if you need some specialization or something which is suited to your requirement, maybe in the AIF space, you may be able to get it on the equity side as well. So I think it's ultimately about allocation, and all the spaces are good as long as the fund manager is managing it in a meaningful manner, and the objective of the fund and the style fits your requirements on the equity side. Thank you.
So the last one question in the interest of time now, Chintan. What is the role for hybrids in the future, which is one. And second, the point over here is that, can I request you to please summarize what should an investor think over the weekend when they are looking at their allocations on the fixed income side, their hybrid side, or any of the FOF categories that they are planning to allocate?
Sure. So the first question, right? In fact, I do remember, I mean, I do a lot of client events, and generally in terms of the allocation which is asked to me, and I end up saying that you need a foundation which is very strong from on which you can build your entire portfolio. And typically, as part of your foundation, which you need to be very strong and can take care of the ups and downs of both equity, debt markets, etc., with professional management. Any money which you don't need for 5 years, 10 years, you want the advantage of equity and debt. Form the core with balance advantage fund, multi-asset fund, and the likes for your parking requirements or your investment requirements where you may need the money for 1 year, 2 year. The equity savings fund category, the equity arbitrage category are most suited. So that becomes your parking and your immediate requirements. If you have any, you can park it in equity arbitrage, equity savings. Apart from that, the global funds, the gold funds, which were mentioned, and debt as a category, of course, is still very relevant. It's not like debt does not loses its relevancy. Debt remains relevant, but just that the indexation benefit is going away after 1st of April. So it is in your interest to prepone your investments in debt, and the ICICI Prudential All Seasons Bond Fund fits in beautifully over there. Any fund which does not need you to take out money after 3 years, 4 years, unless you have a goal-based requirement, is a suited fund on the debt side. On the hybrids, I do believe that the hybrids are one of the best ways, and it's not today, but I remember since 2013, we at ICICI Prudential have been speaking about hybrids, and with the current changes, it becomes even more so important for investors to have a large allocation, a very large allocation to hybrids, depending on your comfort. So equity savings, balance advantage, multi-asset, you have options in hybrids and you can create a portfolio around there. And then you have the typical usual allocations to thematics or flexi cap funds or value funds, which you can do. So I think a portfolio approach is extremely important. Hamid, the second part of the question, please.
Can you please help summarize what are the actionables that they should think of when they're positioning their portfolio over the weekend?
Yes, sure. So first and foremost, you have to get on the drawing table and see where all your investments are. So that is the most important task. Sometimes it may so happen that you may have scattered investments which are lying idle. Get all of it on the table together, that this is my investable pool. Your existing investments, whether they are rightly invested in the spaces where you want them to be invested, ideally very low allocations to, let's say, liquid or money market, unless you need it, in the next 6 months, 12 months. So you may want to allocate as much as possible before 31st of March to debt and other schemes where you want the indexation benefit. So you look at the overall asset allocation, see where the gaps are. And just to highlight, Naren mentioned global investing. If you feel that you are under-invested in global, then the ICICI Prudential Global Advantage Fund of Fund can be your choice. Most investors would agree that gold and oil are two pain areas as far as India's imports are concerned. So the strategic metal and energy can be looked at as an addition. These are some of the names outside of what I normally spoke, right? So to keep it very simple, first, where all is your money? Second, where do you need to allocate? Third, have a balanced approach towards your portfolio. Foundation clearly between balance advantage fund, multi-asset fund, equity savings fund, and then build it with these categories, and then be in a position where you don't need to churn, because now churning has its own cost when it comes to international and debt schemes. It will have its own cost. You don't want to ideally churn. And if you don't want to churn, you want to invest in a space which will take care of credit and duration. That's where the ICICI Prudential All Seasons Bond Fund comes in handy. That's how I would say that. Just see that your money is invested and nothing is left ideal. Thank you.
Thank you. So thank you, dear clients, for joining us on a Saturday afternoon. And I hope, I wish you all the best in your decision making. Our entire team is available at one call to help you with your decisions and anything that you need. I thank Chintan, Abhijit, Komal, Naren. Abhijit, Komal, if you have anything else to add over here.
I think thank you very much. Our RMs will always be there with you to address the queries that we have not been able to address now. And please feel free to reach out to us as always. Thank you very much, everybody. Thanks for your time.
Thank you so much.
Thank you, everyone. Have a great weekend. Thank you.
Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.